What is going on, everybody, and welcome to another weekly update. And what I'd like to do in these videos is provide you guys some upcoming earnings, some upcoming events to get you prepared for the week ahead. That sounds like something you're interested in subscribing, as I do also provide technical analysis for my entries and exits for those stocks that I am looking at throughout the week. And I also provide a daily pulse on the market at Hemi137 on X. So check me out there as well. But before we get started, go ahead and hit the like and let's get this thing kicked off. Now, one thing that's actually interesting that we're seeing is we're getting a lot of news, a lot of information. This will be the last big week of information before we head into the new year. Again, the events that are occurring right now are big events. There is a lot of stuff going on that is going to influence what's going to happen next year. And like I've always stated, I do believe there will be a construction of some sort of event that could be a unwinding of a lot of the debt that we've been accumulating over the past probably 2.5 years leading up to this, essentially trying to get a vote to this point. Now, it's not saying it was just the current administration. It's always been that way. But even more so now, I think there was a lot of influence on the massive spending that's been going on, considering we got rid of the debt ceiling. And now we're starting to see that being reflected. So with that being said, the past week we did have core CPI come out 3.3 versus 3.3 expected. Again, this report's breaking down into so many different reports. It is absurd. But the problem, the concern being, is that inflation is starting to come back. Now, you shouldn't see inflation coming back this fast just from a 75-point basis move that has occurred over the past 2 months. This is way too fast to see any kind of influence occur just because of the cuts. So this is what you need to understand. There has been massive amounts of spending going on over the past couple months, and even now going into the new administration, you have to understand that they are wildly spending because of everything that's going on to try to handcuff the new administration. So we're going to have to see what occurs, because if inflation starts rising too fast, too quickly, you're going to scare big tech. And big tech has really been the only thing that's been holding us up to this point. So even with the new administration coming in and then their cuts in removing regulation, that will help to an extent, but it's not going to be an overnight thing. This is the big worry and concern, is that you have employment that is skyrocketing at this point. You can't do anything else but start to cut or start to ease, because if you start tightening up, or you continue to have to raise rates because of inflation, you're going to lead in stagflation, which is the worst of both worlds, where you have high inflation and high unemployment. Which is something we've been flirting with quite a bit over the past year and a half. So that being said, car insurance inflation is up at 12.7, so still double digits, which is a big problem. Everybody needs a car, or if you have a car, which everybody pretty much needs, you're going to have insurance, and insurance is still extremely high. Transportation inflation still extremely high. Car repair extremely high. Now, the interesting thing about car repair is people, because people weren't buying new vehicles, they were keeping their old vehicles, and ultimately what was happening is they were starting to repair their old vehicles, and you see that change in essentially advanced auto parts. But the problem is now that is starting to fall off a cliff, which means that people can't even afford to repair their own vehicles. Again, they're getting tapped out. They don't have any other means by gathering any additional money at this point. So you have to understand that. So again, it's your 401k. You don't want to diminish that too much, and then you're going to have to start selling off additional assets like houses, property rentals. We're seeing all that start to occur as we're watching the surplus of homes start to increase, which means that's eventually going to start taking down this price gouging that's been occurring. Now, it's not saying you're going to see this across all states. Even during the great financial crisis, when we had the huge fall in essentially the equity for homes, that was only in certain states, and it was so bad in some states that it brought down some of the average. And that's what you need to understand. A lot of people have been moving to these cheaper locations because it's just too expensive to stay in some of these other cities, And so that's where you're going to see. And we're starting to see that heavily reflecting in California and Florida and Texas, that they are cratering at this point. So again, it's not always going to be in the same states. Not ever. This is why they say everything essentially kind of rhymes, right? But it's never actually the same exact scenario. So nonetheless, that's what we're seeing to this point. Rent inflation is still high. Again, all the things that people need, the groceries are still very high, and that's something that's being reflected as well. As groceries are starting to come back. Even the global food inflation is up like 5.5%, I believe. Which again, this is why they've been dissecting these reports, is to try to make it not look as bad. So now you have headline inflation compared to core inflation. And so you have all these different inflations that they keep essentially dissecting it to try to make it look better, when in fact it's not any better. So inflation has still been high. It's never completely gone away. It's come down a little bit, but the problem is we may be shifting back up. So, and then oil demand is been collapsing. Now OPEC has been doing everything they could to try to steer this back up, but it's not helping. And why is that? Because we are essentially going into a global recession or global depression at this point. And you're seeing that being reflected because China has been pumping massive amounts of stimulus into their economy and cutting rates, and none of it is helping. They're getting to a point in which is concerning for us, is that you keep trying to pump all these stimulus packages in and they do absolutely nothing. So that's leading into a cataclysmic event, essentially, where you remove fiat money and you flip everybody to a CBDC. And then at that point, they have full control over what you can. Now, at this point, what they can do is they can freeze your bank accounts, whatever the case is. But at this point, they won't even allow a transaction to go through if for some reason your the social credit score that they can essentially base this off of, if you are against the narrative, they can essentially block you from paying for anything. So they could cut anything off. This goes for the food that you buy. Maybe you're buying too much of one thing, they can cut you off from doing that. That has been largely the concern when you're talking about these particular scenarios. So, and then, like I said, the global command on oil, right? Nobody's buying anything. This is why it's all fabricated when it comes to the demand. And I ultimately understand, once the government seizes up on the spending, then you're going to be shown what's actually going on, and it's not going to be a pretty sight. And even over the past week, Trump did the opening bell for the NASDAQ, and Jim Cramer was interviewing him, and he had also gestured or talked about the fact that there may be a dip in the market. And he's aware of that because he knows that there is a debt bomb that's already existing at this point, that's about ready to go off. Not by any means of what he's done, but it's what he's inheriting. And that's something you need to understand. And largely because of the pandemic that occurred, and how it takes multiple years for that to play out, is ultimately what we're concerned about. Now, corporate executives are now selling their stocks at record levels. Again, we've been talking about this multiple times. It's continuing to happen. We're seeing it across all industries. So nobody's big tech to pharmaceuticals to everything. There's a lot going on there. And so those are things that you need to keep in mind. In Tesla even has been popping over the past couple of weeks here, but there's even rumors and discussion about potentially another stock split with Tesla again. Which is crazy, to try to preserve the wealth because they're concerned about what's ready to happen. Now, so for the first 2 months of the finished fiscal year of 2025, total debt stands at $624 billion, the highest on record. So again, they are continuing to spend at a ridiculous amount of money. So the only reason why we're at all-time highs in the stock market is because the crazy spending that we are doing. We cannot sustain this, despite what Powell's brought this up multiple times. He's tried to walk it back a couple times or try to dilute the impact of what he's saying, but ultimately it's still a huge problem. And then U.S. largest bankruptcies are now at the highest level in 14 years. Again, everything is falling apart. If you cannot see that, which I'm which it's pretty obvious. I think the majority of America has seen it. That's why they voted for Trump, I believe, because people are tired of the way this economy is. Inflation has not gotten better. People are working more jobs. Things have not gotten better over 4 years. Things have gotten a lot worse. And we really need someone in there that's actually doing something to make an impact on our economy, because our economy is falling apart as our roads and everything are being destroyed. And even all the aftermath of the hurricanes, people are still ravaged by those hurricanes that hit just a couple months ago. And then we're still sending billions of dollars to Ukraine. Ukraine got a $50 billion package here. I think it was on Wednesday. And then on Thursday or yesterday, they essentially sent another $500 million. And then we've talked about this, how it's essentially been this huge money laundering scam that's been going on, and those kickbacks keep coming back to these big military industrial companies, right? And then there's those, again, lobbyists that essentially give back to the politicians. So it's all a huge scheme. And then you even want to talk about, you can even go further back to 2014, right, where they overthrew the Ukraine government and put Zelensky in charge, right? There's a lot of scheming and corruption and fraud that are occurring right in front of our eyes. And again, we're starting to see a lot of that stuff unfold as we get closer to having Trump in office again. And a lot of this debunking that they are more prepared now than they were in 2016. And I think that this gap in 4 years has actually done more of a benefit, as it's allowed the new administration to get a better grasp and idea of the corruption and what needs to actually be done when you're in there. And so I think that gap actually helped as opposed to make things worse, despite everything that's gone on. So with all that being said, upcoming week, we have interest rates, which is at a 95% chance we get another 25-point basis move cut. So we need to be paying attention to that. And then we'll have Powell, the last Powell we'll get before the end of the year. Again, expecting him to be very dovish going into the end of the year, just like he did last year when we were supposed to get all these cuts in March, and we didn't get cuts till I believe it was like August or September. So again, they're talking about stopping rate cuts. Biggest thing is in January, what we're going to have to watch is we have one plan that we're going to have all these gaps in between when our scheduled monetary policy is. Once you start watching unemployment start falling through the floor, they have no choice but to cut, because you can't produce if people aren't working. And so that's the huge problem. They don't have an option but to cut. So then you're going to worry about inflation. But the biggest problem is, again, with inflation is the massive amount of spending that's going on. So if you ease the spending, that should help with inflation as you try to build back up the workforce. But again, you have to build confidence, and people have to build their savings and everything else. And that takes time. So again, will be interesting, but this will be the last major scheduled event that we have for the year until we get earnings cycle in here a couple of weeks in January 15th. So then Friday we have core PCE, inflation starting to creep back up. So again, highly, highly concerning. But it won't be as impactful. Again, core is our biggest impactful inflationary reading that has the largest impact that can make directional changes in the market. So that's what I mean by impact, is it makes major directional changes, not just intraday. So a lot of these data sets can have intraday moves, especially if they're wildly off expectations, but ultimately, again, understand that we are looking for pivoting data. And again, inflationary data isn't always going to be pivoting data. It just depends on what the current market sentiment is at the time. And right now that we're cutting, I said we had to start paying attention to inflation gauges, especially core, because now we have to start watching inflation start rising again. So and then next monetary policy, we have December 15th and then January, and then you're going to have a gap for March, and then a big gap till June. So emergency rate cuts, if we go back to 2020 or 2008, right, January, we had emergency rate cut on top of the scheduled cut. So this is what we need to start watching is next year, early next year, what the Fed are going to do. Are they going to start cutting rates rapidly? Because again, the numbers are way worse than anticipated, which we've been talking about. So it's not like it's really been anticipated. We knew about them. So just keep that in mind. The next earnings life cycle, earnings life cycle. Next earnings is scheduled for January 15th. Again, it's supposed to be one of the biggest spending times of the year. We're not seeing that already on a lot of these data sets. So it's largely concerning that it's not a buy now, pay later that is currently going on. And the delinquency rates, again, are way worse than a credit card, because you miss one payment, you're paying like 40% interest rate on that missed payment. Now, again, you can go file bankruptcy and then not have to pay that. But again, this is why a lot of these, like Affirm, UPST, a lot of these companies that are doing these things are in trouble, right? At the same token. So, because it can't remain like hugely profitable because of that fact that a lot of people can't pay for these loans, right? If you have to essentially payment plan your groceries, that is a huge issue, and that's what we're seeing, because people are splurging on groceries because that's all they have aside from their home, their vehicle, and insurance. They can barely even pay for food on their tables. So expected moves. We got the SPX back up to normal levels. Tesla is really high because Tesla's been on the move. So watch out for that. We'll see what continues to happen there. Again, if inflation continues to rise, which again, we're kind of in that last thing where we're going to start running up towards earnings. And then when the actual earnings are reported, that will be the telltale sign on where we're going next. And again, we normally have a correction, one of the biggest corrections around that February-March period. We need to keep that in mind. So after this earnings cycle, expect a pullback. That may come earlier, that may come a little bit later, but it should be around that time. It should be right around earlier, sometime in February to March is when you have your major corrections. So it just depends on the series of events play out during that time. Boeing is at normal at 7, and then JP Morgan's at 6. Again, this is much higher than anticipated. It's normally around 4. So the fact it's up to 1 point is big enough for JPM, but the fact it's been sitting at 6 for a couple months is largely concerning, as they may be anticipating something major to happen. So just be mindful of that. Again, what we talk about here is potential events and actual events, scheduled events, and the impact it has on the market, so you know how to manage your risk during these times. So again, there's things to keep in mind as we continue to move through these things. So with all that being said, go ahead and drop a like, and I will see you guys on the next one.